Right, good evening, ladies and gentlemen. Hopefully you can hear me now as we start our first webinar investment update with Douglas Kearney, Intelligent Pensions Investment Director. So if anybody's having any problems or wants to ask a question, you should find some icons on your right-hand side. And if you click on those, type a question and send it to us, the organisers will get back to you. There's also a facility to raise your hand if you have an issue. And if you raise that, we'll try and communicate with you and come back to you. All the attendees will have to be on mute during the webinar, only because if we put you all on unmute, it starts to create a lot of feedback and noise. So just to prove that Douglas is here, this is live and exclusive from the Glasgow Financial District. I'll give you a quick picture of Douglas. There he is.
Good evening, everybody. Good evening. Thank you for joining us.
I won't make you endure that picture for too long. I will take him off. I'm going to hand over to Douglas now, who's going to talk to you for 20-25 minutes. And please send questions through at any point in time using the questions, and type in your questions, and we'll get back to those when Douglas is finished. So, Douglas Kearney, over to you.
Thank you very much, Andy. Good evening, everybody, and thank you, as I say, for joining us. What we intend to do tonight is to go through very quickly the investment process that we have. We seem to have a little technical...
Oh, has it not started at all? You've not heard anything, no? All right.
The broadcast is now starting. All attendees are in listen-only mode.
Right, good evening, ladies and gentlemen. Hopefully this is us now starting our broadcast of our first client investment update webinar with Douglas Kearney. My name is Andrew Penny. I'm the Marketing Director at Intelligent Pensions. This is quite new technology to us. This is the second time we've started this evening. So apologies, but hopefully you're now all hearing me loud and clear. You will have on your right-hand side of the screen a little dashboard which will allow you to ask questions by typing them in. And you can also raise your hand if you have any questions, or if you're having any problems hearing us or anything else. Please do so and we'll try and get back to you. Now, to prove we are live and exclusive from the Glasgow Financial District, I'm just going to show you another picture of Douglas. You may have seen this already, but here he is.
Good evening, everybody.
Now, I'm not going to make you endure that picture for too long, so I'll take that down immediately. But I'm going to hand over to Douglas Kearney, Investment Director here at Intelligent Pensions, and he's going to talk to you for about 20-25 minutes. But please keep your questions coming in if you have them, and we'll tackle those at the end of Douglas's session. You will be on mute for the whole of the webinar, only because if we put you on unmute, it just creates background noise and nobody can hear anything. So, Douglas, over to you.
Thank you very much, Andy. Good evening, and thank you for taking the time to join us. What I intend to cover tonight is really to take you through very quickly how our investment process actually works, an overview of that, take you through what the global landscape looks to Intelligent Pensions just now, maybe one or two asset classes and markets to give you a feel of what we're seeing, and then draw it to a conclusion with the opportunity to ask the odd question at the end. No presentation right now would be good without an exit poll, and this came out today from Schroders, which is quite interesting because what it's actually showing there is the confidence levels in the global market. This is a survey done throughout the world by Schroders. I think that some magic number of about 22,000 people. Seems to be that 22,000 is the right number to get the right answer. But broadly speaking, people are a lot more confident than they were this time last year, which for us all is good news. That is not just the UK, that is everywhere we go. What this survey also showed is that the people are expecting growth in their portfolios. 91% of the people, that's 22,000 times 90%, that's 18 odd thousand, expecting that growth will be there in some reasonable shape for them, which again, very encouraging. Schroders also looked at individual markets, and what did they see? They saw that most people thought that the asset classes and the regions were going to improve as well. And as we can see, and we'll talk a little bit more about it, Europe's moving up. America, has it reached its peak? Who knows? It was up a lot last year. And emerging markets. So we'll have a look and see what we can find with that. What they came to the conclusion was that in 2015, that broadly, confidence and optimism is the best it's been for some considerable time. And they've done this report now for a few years. So it beats 2013, beats 2014. So people are feeling extremely upbeat, which is great, absolutely great. So here we go. How do we go about establishing portfolios for people? And maybe some of you have heard this before, but if not, it's just a quick run through so you get an idea. We work in a bespoke way. Every individual has their own needs and their own dependence on their portfolios, and we build that in. Each portfolio has to be built to reflect these variations, but fundamentally they all consist of low, medium or higher risk funds. Now, low risk fund might be property and fixed income, not the flavour of the month for many say, but I'll try and prove that that's a little bit a depressed view. Medium risk funds would tend to be UK large companies, mid-cap companies, global and UK equity income and global equity. And higher risk is basically everything else. Global regions, smaller companies, UK special sits, gold, maybe that's something we should talk about another time, but gold's coming back into flavour, believe it or not, and natural resources. What we do is we concentrate on externally rated funds. If the fund needs to be rated by a third party to give us some comfort that we're not just getting ourselves lost in the fund manager's chat. So we review the funds quarterly, but actually I review them much more frequently. We hold meetings with the fund managers on a one-to-one basis. We want to understand their views, their strategy, their positioning, and indeed their concerns, because they do have concerns in all the different asset classes that they look after. We adopt a very long-term view and often at times counter-cyclical. But the bottom line in investing is what you pay affects your return. So if you can get in somewhere at the low end, you will definitely get a much better return, and that's been proved many times over. We rebalance portfolios annually or indeed more frequently, depending where you are in the stage of the retirement cycle. We don't use multi-asset funds, not that we disagree with them fundamentally, but for us they don't work, and I'll try and explain why. This is a multi-asset fund chosen at random, no particular reason about it. You see all the asset classes there: corporate fixed interest, equities, North American equities, property, European equities, things that you've probably seen in some of your own portfolios. But whenever you buy a unit of that, a pound of that, you're buying 21% of the corporate bond or 17% of the UK equity or a bit of Asian Pacific equities. And whenever you sell one unit of that, you're selling a bit of everything. So you're wanting everything to move in the same direction. Well, it doesn't. It never does, and it never will. Asset classes move in different ways at different times, and that's what we try to reflect. So the portfolios, and I'll show you how we design them. For us, we would describe them more like Range Rovers than Ferraris or Lamborghinis. They have to work in all conditions and try and give you a decent, smooth ride. Many people think we should be driving Ferraris on a nice sunny day, and I go along with that. But when the snow comes or the ice comes, I'd rather be in the Range Rover than in the Ferrari. In particular, when you're in retirement and you're needing your fund to do its job for you, losses are very hard to make up. So at all costs, we try and avoid any losses being crystallized. Diversification is vital. And of course, negative correlation, asset classes moving in different ways at different times, is always sought. Harder to find these days because there's been a bit of a tendency for asset classes to shift in the same direction, particularly from the financial crisis onwards. Defence becomes much more important than offence, but achieving growth is still vital. So let's just have a quick look. This goes back to the time of the financial crisis, and you would have had in your portfolio a whole range of assets, but these were the two that you would have looked at. Global equities could have been anything, anywhere, and global fixed interest. And as you can see, the global fixed interest started to perform as the world became extremely difficult. And therefore, if you had that in your fund at the time, you would have just left your global equities alone and cashed in some of your global fixed interest to meet your bills and pay your way without taking a loss on your global equities. And lo and behold, as the world started to recover, you would start to shift and start to realize some of your global equity profits. So you're not crystallizing losses. Losses are heck of a difficult to make up. So you can see there the key points. Do you remember that awful time, the financial crisis? Here we go, it starts to move, and again, we're good. So income can be met from selling the units which are ahead at the particular time. So let's look forward. This is just a sample of all the different asset classes over the last 10 years. And what we're looking for here, and I'm going to go through this quite quickly, is let's see where the profits are in each of the years. And are they everywhere? No, they're not everywhere. We can see there that Japan was the leader. The next year it was a different one. It was smaller companies. And off we go. It was the next year global emerging markets. And then it was global fixed interest. I think we're into the crisis at this particular point in time. And it moves on again. Smaller emerging markets was the leader. Then on it goes. And you can see that each time something is always in the lead. And what that says there in the pink is where the losses would have been if you'd actually crystallized them. Quite a few through the difficult times of the financial crisis. So what we do is we build portfolios using a variety of asset classes that hopefully some will be in the positive in the worst of moods. We've done this through two downturns in the market. I mean, one was just horrendous through 2008 and 9. And fortunately, we always had profits in portfolios to crystallize. So let's move on, talk about the investment landscape. What are we actually seeing? I thought that when we planned this, we'd be talking about the UK election, but actually we're not really. The UK election was a surprise result, or the pollsters got it wrong. Certainly the markets like the certainty that's been created. Certainly the Euro referendum will be a potential drag. It's going to give us some issues, but there was a very interesting article in the FT today talking about how Denmark solved the very same problem that we're facing. With a bit of clever legal work, they got an answer, and I have no doubt that Mr. Cameron and his team will find way through all this, which will be quite interesting. So I think the pollsters now rank alongside the credit rating agencies for being able to get things wrong, but still being prepared to tell us how to get things right in the future. But never mind, we move on. What we're seeing is strong corporate earnings. Growth is going to remain elusive globally, and I think that's the key feature over the next year or two. That's the thing we've got to look out for, and we should all be looking out for. Is growth going to come through? We can't see re-ratings in shares. I think we've seen the re-ratings take place, so it is now growth. Are we going to find it? The US dollar, we've all seen that being very strong, and it's been hampering US earnings. A drag with their overseas earnings are being hit by the very strong dollar. In the last few days, it's weakened a bit, but today it's strengthened again. The data coming out of the US and China is still weak. You need these economies to be marching on because they're big consumers, but the data doesn't appear particularly attractive right now. But we'll see. Quarter one is always a funny quarter, particularly in the States. It has a sort of climate impact upon it, which is often sort of people question it. But the US market is 70% domestic consumer driven, so maybe that explains some of it. The recently weaker euros helped European corporates. We've seen that, the growth coming through them, and partly to do with earnings growth and translation of foreign currency. The reduction in oil price, it's been a substantial tailwind for a lot of markets. We've still got the Greek problem. We know it's there, everybody knows it's there, markets know it's there, there's no doubt it's not an unknown. But I still think if something happens to that, we'll probably see some shift in the markets because markets have to react. They hate to stay still. But according to all the information that we have, talking to the fund managers and their advisors, they know it's there and they've got it built in to try and cope with it as best they possibly can. We don't think it will be a dramatic problem, but we shall wait and see. Hopefully a solution will be found. The bond markets, they appear to be on the move. That's been the chat over the last week or two. Higher yields impact prices. You've probably heard of the phrase duration. That's to do with the time that a bond has to mature and the movement in interest rates. So all the fund managers, they know that. They're positioned. They've understood it. Where it's impacted most of all is probably been government bonds, and we'll maybe touch on that in a moment or two. A lot of people think inflation is almost gone. No, it's not. It's low, and it will be back because inflation is the government's best friend when it comes to paying down debt, because you can shrink it and shrink it as the inflation kicks in. Interest rate rise is undoubtedly inevitable, but when is the question? I was at a seminar a year ago just now, and there was talk that it could be last August, and it could have been later in the autumn. We're now seeing the Americans pushing it back, and quite honestly, it could be 2016 before it happens, but it will happen. It is going to go. The US will be the first. I don't think anybody else will go first. The US will go first, and then I think the rest will follow in, and we will be right behind them. It's a tough one for the Fed. They know that because it impacts the bond market, and the whole world really does price bonds off the Fed rates, the Treasury rates in America. the 10-year Treasury rate is the crucial one. So we'll have to wait and see when it's coming, but it could be 2016. How does the United Kingdom look? Well, as I said, their election result has been good for equities. There's a bit of stability around, which wouldn't have been there. The market's not been particularly strong over the last few days. It was a terrific bounce on that Friday because I think everybody got caught by surprise. But if there had not been a positive result, and that doesn't mean a politically positive blue, green, red, or whatever colour you want to be, but it's the certainty. It delivered the certainty, and that's what the market liked. The election result, the Euro referendum, is going to be negative for sterling and negative for fixed income. That's a drag. There's no doubt about it, and they need to sort it. And I would imagine if they can bring the referendum forward, they will bring it forward because it will hang over the market and be used as excuses. The word to hear for the next 2 years, or hopefully less, is Brexit. This is the Britain leaving the EU. I was at a seminar with Old Mutual Conference last week, and one of the highly rated fund managers who actually advises the government believes there is nothing to fear from an exit from the euro. He believes if they had a vote, it would be about 70% in favour of staying in. So we will see if he is right. I actually do believe that they will find a solution, as I said earlier, and it will be interesting to see Nicola Sturgeon and Mr Cameron on the same platform wanting to stay in the euro. We'll watch that one with interest. The UK market, it is global. The mid-cap market is almost wholly global, so we mustn't just look at the UK market and think it's domestic. It's not. It's substantially a global market. The economic landscape in the UK, though, is good. It's reasonable. It's on a reasonably sound footing, and it looks as though we've got 5 more years of certainty, which hopefully will allow it to develop. Equity valuations, wouldn't call them cheap, I wouldn't call them expensive, they're close to being fair value. That's a little graph showing where the UK valuations are at the minute, and the average PE, as was the blue line, we're not much above it, so therefore we're not overpaying. And if you go back to the crazy times of the dot-com boom, you'll see there where it went sort of a bit too skywards. So at the minute, we're slightly above average. What you pay for is what you get back. We've got to remember that. But it cannot be considered to be expensive. It is fair value. I've thrown this next slide in just as a bit of interest. This is from BlackRock, which I thought was quite interesting because there's a lot of debate out in the market. Oh, passives are the winners. Last year, the FTSE returned about 0.7%. It was a poor show. It was quite disappointing. But as you can see, it was built up by a bunch of losers and a bunch of winners. And that's what we pay the fund managers for, the active fund manager. We're not looking for him to stick to the benchmark. We're looking at him to try and find the winners and try and minimise the losers. So as you can see, the ones on the far right have done extremely well. Some of them up nearly 90, 80%. And some at the bottom, as you've heard of, the old Tesco and the Royal Mail, had a bit of a tough year. So slight plug for the active against passive. Nothing wrong with passive, but sometimes active does pay off, and I think last year is a terrific case in point. So let's move on. We'll have a look at Europe. Europe's been really quite the flavour over the last wee while. It's been the black sheep for a whole host of different reasons, but it's now becoming quite a firm favourite. European fund managers, I believe there are lots of good opportunities out there. The currency's weakened. The earnings are now beating forecasts, which it hasn't done for a long time. The costs have cut. They went through that post the global financial crisis. The companies cut all their costs. They reduced their debts. So the companies are in actually quite good shape. The Eurozone corporate profits are now anticipated to grow. And as I said earlier, Greece not seen as a massive cloud, but it is a cloud. These are the drivers that are kicking off in Europe, which are really helpful. We can see the trade-weighted euro, the currency coming down. That makes the European export game a little bit easier because their goods are now that bit cheaper. Everybody wants cheap currency at the minute. Everybody wants it. They need to get exports going strongly. So Europe's well placed. We know the price of oil has dropped quite considerably. It's sort of shifting about a little bit just now. It's up a touch. But oil is so important to Europe because they are an importer of oil rather than a producer. So a cheap oil price is really good for them. And as you can see, the consensus growth forecast for the Eurozone, and it breaks it down there in that little chart, are really quite pleasant on the eye. So we think that Europe has got a lot going for it. It's closing the gap in terms of earnings. The sort of grey line there is the American the trailing EPS, earnings per share, and the blue line is the European one. As you can just see there, there's quite a dramatic little kick up towards the end of the chart there. So the closing the gap in America, which is historically where it should be, at the minute the gap is far too wide. Yes, the cynics will say, well, America is far too strong. Not necessarily true. We believe that gap will close. What we have here again is another chart showing the medium-term earnings gap between America and the USA. And as you can see, the European line in blue is really strong. So there are lots of things there making Europe look quite attractive. In the wider picture, when you look across the US, Japan, emerging markets, the UK and Europe, again, Europe is looking strong. Japan's had a terrific time. It's gone through 10 years of hell, but it's now coming out the other side and is looking reasonably good. And what this chart is showing is the companies, the downgrades against the upgrades, and the upgrades in Europe, the earnings upgrades are kicking on nicely. So that looks all quite good. The other ones look okay as well. There's nothing too dramatic there to get concerned about. So in general terms, the wider picture is looking reasonably good. Most investment houses at the minute would call themselves neutral on the US, but not negative. They think the US, and I don't think it could have ever performed as it did in 2014, it was a very strong year. We know that there's a strong dollar. We know there's momentum lacking. We know that there's weak data coming out of the States, but the States is a massive economy and it is ploughing on. India, probably one of the strongest markets in the world, and it looks like it's going to stay that way for some time if the political stability can be held, which it looks like it can be. And China, regrettably, remains challenging. It's probably overborrowed. It's probably not growing as fast as it's reporting, but it is a huge market which the world needs to function and function well. India and China are indeed the future. Asia viewed as strong in new technology, and we've exposed most of our clients to something like the Baillie Gifford Pacific Fund, which is really the home of the Internet of Things, how the Internet is being used, and the Asians have really adopted it and taken that technology on. Most houses view Japan and Europe as positive, and we're trying to build that into portfolios. We don't actually identify Japan as a single asset class, but we build it into our Asian exposure. I think the common theme, as I said at the outset, is growth remains broadly sluggish, and I don't see that changing anytime really soon. Everyone's looking for a weak currency to drive up their exports, but who are they going to sell them to? I don't think the emerging markets are going to be the home for all the exports, but we'll see what happens over the next year or two. But everybody is looking for a weak currency. Bonds, yeah, topic of major sort of concern in the papers and whatnot, and I can understand why. They've had a massive bull run for years. I would argue strongly that they haven't behaved the way they should have behaved. They've been far too strong in many ways, and that's been a bit of a concern in the investment world. Whilst it's lovely to get the profits that they've delivered, it's also concerning if they're not kind of doing their job as they ought to. Many people have been anticipating a reversal, almost to the point of the broken clock. They've got to be right at least twice a day. Well, the reversal, I don't think, is quite on the way. We know that interest rates have got to rise. We know that yields have fallen to lows, beyond belief lows. We know some have gone negative. No, that's not sustainable. It never would be sustainable. It's all part of the QE experiment, which I think has broadly worked. But we don't know what happens at the end of QE. We're all kind of sucking it and to see what actually goes on. What we've seen over recent days is a change and yields increasing. But that's really in the government market, in the treasuries, the Eurobonds, and back here in the UK. They've got to increase. Some of them are negative. The German Bund is negative. Crazy. They are going forward. They're going to increase. And of course, as yields increase, the price will fall. And I'll try and explain why some of the bonds in our portfolios should be sheltered from a lot of that noise. The oil rally, it's halted the dollar's rise and the spark to sell off. Inflation will return and rates will rise. Can't be a surprise. We know it's there. The bond managers know it's there. The consensus is that returns from bonds will be lower from here But I would argue, so they should be. So they should be. I've got two comments that I picked up last week from the Financial Times. I'll quickly read them out. Markets have finally recognised that the European indicators weren't validating the extreme pessimism, indeed, that the government and corporate bond yields near zero were pricing. Absolutely. The prospect of the US Federal Reserve pushing out its first interest rate rise has removed a major deflationary force. Governments want inflation, and inflation will come back. If growth momentum does not rebound more meaningfully in the coming months, even the September meeting, this is of the Fed, which is still our base case for a liftoff, might be too soon for the Fed to gain the necessary confidence in the sustainability of the recovery. So we don't know when it's going to happen, but we do know that it's going to happen. Now, I counter this with one of the decent fund managers in the bond market that we've got the privilege of supporting. He's a very, very astute Northern Englishman who says it as it is. And his view, which he gave to us, was that quite simply that the Bank of England, if it's going to raise rates this year or next, will not wipe out bond fund performance as some experts are predicting. His fund, the Royal London Sterling Extra Yield Bond Fund, returned around 9% in 2014. 7% was from income and 2% was from capital growth. And Eric's question to me is, where do the skeptics think this income is going? It's not going anywhere. And if rates go up, so it'll improve. So we do know, looking at last year, bonds had a terrific time. They've had a terrific time for a long time. The FTSE, which is the old share there, had a dull time. And yeah, 2015, we're seeing a bit of a reversal of that. But I would argue amongst the investment community, that is what you should be seeing. We'd like to see, of course, everything on the upward trend, but that's not abnormal for the bonds to be coming down and the shares to be going up. That's what we want. That's what we need. We know that bonds deliver. This is a chart that shows how bonds perform and stocks don't. And that's why they're in portfolios. That's why we think you're protected by having bonds. Not government bonds. We haven't liked them for some considerable time. But corporate bonds, strategic bonds, and high yield bonds have a place. And income is part of the major part of the return, whereas capital isn't. And as I said earlier, the fund managers are acutely aware of what's going on in the bond market, and they're all positioning their funds to take effect of that. There might be wobbles. It's probably going to be a difficult, volatile year. But if you speak to a fund manager, he will tell you volatility he just loves. I got this from Vanguard, one of the big passive funds. It does actually do active funds as well. And they have worked out and modelled that this is the probability of where interest rates will be over the 10 years. And as you can see, the bulk of people think there'll be a workers out about 2 to 3%, and very, very few does the distribution end up at more than 5%. So it will be a slow road to get to 2 or 3%. And as I say, the market knows it's on its way. Let's go to another asset class before we finish, which is property. Property, many people hated property from 2009 onwards, but property's done really well. And you can see in that chart there, it's all moving in the right direction and is forecast to carry on doing that for some considerable time. There remains a shortage of supply. We watch that carefully. The property managers watch that carefully. If demand and the cranes go too heavily into the ground, we will know there'll be a turn coming at some point. But for the foreseeable future, what's that in investment terms? 2 to 3 years? That's got a long way out, but we'll give it that. 2 to 3 years, we think we'll see double-digit returns from property across all the particular sectors. This was produced to show where the returns. So the total return from all property over a year was around about 17%, and the annualized was about 10%. We think that's going to be maybe not quite as high, but we expect to get round about the 10% through all the asset classes if we choose the right funds. And we're so far looking as though we're in the right place. So property we like it lots. Bonds we haven't given up on, and we still like equities. We think equities have a strong way to go. So what are the conclusions from all of this? The election result delivered certainty. I've got a question mark in that. Unfortunately, there's all the parties have now blown themselves up, and we'll see where that gets to. But there's certainty, at least for the markets, and that's what matters. UK fixed income managers are facing the biggest challenge as the Euro referendum will weaken sterling. So a quick answer to that, please, if we can get it. The US, due to its dollar strength, may see earnings hampered, but this could be wrong. I don't know if you saw the results from Apple a couple of weeks ago. Outstanding results, fantastic. So maybe it's not as bad as they make out. The euro is weak, getting stronger, getting weaker, but it is weak. It's going to strengthen at some point. Many euro companies are actually beating the expectation. Great. Europe for us looks to be attractive for a whole host of reasons, which I've explained. The US, due to the dollar strength, may see earnings hampered. Bond markets are challenging, but change is underway. Let's not fear it. Let's seize the volatility in that and let the managers get on with it. Interest rates, big question. When will they rise? Who knows, but they're going to go up. Property is doing extremely well, will continue to do so. The data and business conditions around the world appear to be pretty reasonable, nothing to get too fearful of. But overall, it's a slow growth world. Opportunities do exist, but as any manager would tell you, they love volatility. Volatility to them equals opportunity and offers them tons of chances of profit, which we're looking for. So there we are. That's the first investment webinar to give you a flavour of what we are seeing out there, and I hope you found it useful.
Right, well, thank you very much, Douglas. I think that was very useful, a very different way of communicating and engaging. But now it's over to you. If you would like to pose any questions to Douglas about the investment markets or any of the things that he's just gone through, then now is the time to type your questions in. I think we've just got one question come in there, which is there anything in the rumours, Douglas, that there is a market bubble?
Well, you could argue it both ways. All I know is, and 2 or 3 fund managers have told me that everybody that they talk to is waiting for the markets to fall. There's a wall of cash waiting to go in, and the view is you're going to wait a long time. There is no fundamental reason why any asset is overvalued, and there should be a massive shift. So we can't say no, that it's not a bubble. All we do know is that the American market's been on the longest bull run, but it's come from a place where it's never been before. We know that the bond market's come to an end in the sense that the bull run's over. Bubbles? No, I don't think there's bubbles. I think it will be a volatile period for the next wee while, but after that volatility settles down, I don't really anticipate anything dramatic. But we watch it, and we watch it almost by the hour, by the day, and we talk to the managers. But as yet, nobody in the fund management community is shouting bubble and going to cash. Only one guy, funnily enough, I do know, and we've got a touch of his fund, is a bit more pessimistic. But that's not about bubbles, that's just about earnings. So no, I'm going to back off on a bubble.
Thank you, Douglas. Hopefully that was the answer you were looking for. Another one here, it's are better times ahead for smaller caps valuations? Yeah,
there was an article today in one of the trade papers talking about that. I think smaller caps got a rough time last year, and particularly I believe that the smaller caps will do quite well. There's a lot of IPOs coming to the market. They tend to do better on a recovery. I think we're seeing the recovery going like last year. It was just people taking profits. So yes, I think smaller caps, carefully chosen, will do pretty well. And so far, they have done pretty well this year. They're moving in the right direction. So we still quite like small caps. I don't know. I think that's probably about it, is it?
Yep. No, I think that's it for the questions. I'm not going to hang on for any more. But what I would like is there's a couple of questions you'll be asked when you leave the webinar, and be grateful if you could complete those questions and let us have any feedback on whether or not this is something you want to see more of, and a good way of engaging. So please just let us have your feedback and any suggestions on future topics you'd like to see covered, whether technical or investment or whatever whatever you want to see us do, really. So only remains for me to say thank you very much, Douglas, for your time and your words, and thank you everyone for joining us, and hopefully we will speak again soon.
Cheers, good night.
So good evening.